Now, areas of growth focus that are on my horizon, or at least on my agenda, is going to be that technology and infrastructure. This is going to be another area that continues to be, I think, a proliferation within our economy. It seems like the technologification of everything is right on the, right on the cusp. I mean, it doesn't matter what you're getting, whether that your mountain bike has electronic shifting or your car is self-driving. It's pretty much everywhere. It's pervasive. And I think we're going to see some winners. And I think, unfortunately, we're going to probably see some losers as well. But some areas that we're looking at is, the cloud computing tends to be a really powerful space, or at least a good space to be in, partially because of just how much data AI uses. And so having some of that cloud computing, the digital infrastructure, I think is really important. So how do we actually deliver the things that we're building and things like that? And then the applied AI, I think, is another long-term theme. So actually taking AI and applying it in a real life scenario. It's not just a chatbot that you can work on. It's something that's actually doing real work and helping the employees of your corporation do work that's better, that's faster, that's more productive, that's more efficient. So I think that that's certainly a big area. I think a key is going to be durability. Looking for companies with sustainable models and strong balance sheets is going to be something that we look at. I always like to look at like free cash flow. And I also look at, are they actually generating revenue? There was a period of time during the 2010s that we had those unicorns, if we can look at them, let's just call it like an Uber, where they were just generating a lot of revenue, but they were operating at a massive deficit quarter after quarter after quarter. And obviously they were still growing as far as their share price, and they were everybody's favorite kid. But then all of a sudden things kind of hit the skids because people realize that profitability and revenue, at what cost is your revenue going to be? I think that really makes a lot of sense. So that was something that we saw from the last, let's call it 10, 12, 15 years, that potentially could be at play here in a way that's actually positive for the investor, meaning we're going to be looking at companies that are actually growing, that actually have strong financials that are going to be driving the growth of this market. Another area, as I mentioned earlier, is global diversification. So I believe that international exposure and emerging markets, if you're going to be selective there, are going to be potentially attractive. And I think that we can look at the super cycle that we saw during the 2010s and really the last 15 years, where the U.S. economy, the U.S. markets really dominated the entire game. And we saw international pretty much underperform almost every year, it seemed like, at least broadly. And from that perspective, that was, that's not normal. And I think there's a bit of a revision back to the mean, where we actually start to see international exposure pay off, just like we've seen here recently with fixed income and your corporate bonds. But with global diversification, I think that there's some really cool trends that are happening, demographic trends that are existing, where we are seeing a younger population growing into those mature years where they're spending, where they actually have that buying power. So I certainly think that there is a story to be said that international exposure is going to be a strong place to be. There's certainly some tailwinds to be looking at. I would say that the offset of that is the potential for some political risk. And we've seen that a little bit, just some inklings there. Now, these are going to be countries that I referenced that are not probably going to be on the top of our list as far as where we want to go. But even just what we're seeing with Iran, with Venezuela and some of the others, is that there is some political concerns there. But overall, I think that that international diversification, international exposure could benefit greatly here in 2026, just like it did in 2025. But again, that's something that we need to be a little bit more selective of, and something that we're looking at more as a scalpel, as opposed to busting out the chainsaw and just ripping up things. Another area that I think is very much in focus, and it's in a good way to a certain degree, which is fixed income or bonds. And I think we've seen a big rebound over the last couple of years. 2022 was one of the worst years in the bond market, and it's hard to believe that we're still sort of recovering from that. But historically, unbelievably bad year in 2022, and that was largely driven by this rate increase that just shot through the roof. And that negatively affected bonds, and bonds have never really quite rebounded in the way that they had hoped. But now that we're starting to see things kind of come back into orbit, I guess you could say, as far as interest rates coming down a little bit, we're starting to see a little bit more normalization within the bond market. And something that's actually kind of cool to watch is back in 2025, when we saw the tariff tantrums in the markets, bonds actually did what we had hoped they would do. So they were kind of that stabilizer. And something that we hadn't seen, especially, if we're thinking about 2022, where we saw bonds really just not perform at all. In fact, they were down, in some cases, double digits. That was, very concerning for a lot of people. Everybody saw that this was the death of the bond market. But the reality is it's very resilient. It's very big. And I think that they are back in focus as far as, they're earning a reasonable type of return. They're not just for income, but they also can be a great stabilizer to a portfolio. So when people said back in, a couple years ago that the 60-40 or 60% stocks, 40% bonds, which is a pretty typical investment strategy for a lot of folks, that portfolio strategy was dead in the water. Nobody's coming back from it. Now we're starting to see that that's not actually the case. And I think it's a little bit overblown, just like a lot of things are. So we are looking at the bond market as a potential area. And this is something that I think relates to some of our key challenges, which is going to be the private debt market. So I'll kind of touch on that here in a moment, but I think the fixed income market with bonds specifically, and really the investment grade and some high yield as well have performed pretty well. But switching gears here is real assets and commodities. Now, I will tell you, I am not a gold bug. I have never been a big fan of gold or silver. It hasn't been where my focus is. Now, I could call that a bias, but it's hard to deny the fact that gold and silver and some of those precious metals did not perform really well last year. I mean, they performed unbelievably well. And I think that there's still a compelling reason to have some exposure. And so that's certainly something that we're looking at. And, I think it goes to some of this inflation conversation. So inflation, not just here in the United States, but I'm thinking more abroad, is somewhat a little bit higher than they would hope. There is a lot of global uncertainty. So people oftentimes look at like the gold trade as being a safe haven asset. So when things start getting crazy, either people oftentimes go to gold or they might go to bonds, and that tends to be kind of the safe haven assets. And so we've certainly seen that. And I think that just is a response. And I think it tells an interesting story where we are seeing people uncertain. Even though we're seeing strong numbers, we're seeing strong growth, there also is this side of us that seems to be a little bit pessimistic about what the future holds. And I think that that's one of the big key drivers of what's, driving the price for gold to go through the roof. There are other areas like copper is another metal that we're kind of taking a look at as far as just what its involvement in our chip production and really just our industrial production, whether that's building a data center or building a chip. Copper is going to be a big piece of that as far as a metal is concerned. And these can, again, when we look at real assets and commodities, these can serve as a really strong diversifier as well as a potential hedge for that. So some people might use a gold or some sort of a precious metal to offset some of maybe their equity exposure, similar to maybe what they might do with a bond portfolio. So if we're looking at our key challenges to navigate in 2026, I think one of the big things that we continue to talk about, and it seems to be something that we've harped on for years, and that's going to be the valuations. So particularly large cap growth, or even like what you might look at like mega cap. Now it seems like we've got mega cap, large cap, mid cap, small cap, and we can almost combine small and mid into like a SMID type of thing, because everything's consolidated so much that area kind of just is a lot smaller market. And now large cap and mega cap are kind of the top tiers, and those are particularly expensive. And if we just look at the price to earnings ratios, those are pretty historically high. What I am curious about and how things go in the future is that just an adjustment up. Historically, I think the S&P traded at about a 14 multiple, and a lot of these companies are trading in the 20s or 30s. And so I think that that's certainly something that we should keep an eye on. And, I think that that's a major concern. So if we look at, some of like the Teslas of the world, they're trading at really significant multiples. So this doesn't necessarily mean that a downturn is inevitable, but if we have to get back to some level of normalization, that gets back into a couple things. We either have to bring the price down and keep earnings stable, or we keep the kind of the price the same and increase earnings. So there's a little, as far as normalization, there's a couple ways that we can get there, but I think it certainly is going to be way more heavily dependent upon what earnings really look like. And so if we start to see earnings sort of slip, then I think we're going to see that price per share really drop. So that could potentially be a normalizer. And again, this isn't necessarily exact, but it certainly does point to the fact that, something's got to give if we're going to be at these super high valuations. Concentration risk, similarly tied to the valuations, but we've seen concentration or I guess a handful of mega cap companies really drive the growth. So, and it's in a massively disproportionate way. And we saw this in 23, 24, 25, where we saw the NVIDIAs, the Googles, the Apples, the Amazons of the world. They drove the S&P 500 returns by a massive amount. Maybe the top 7, 8 companies returned, anywhere between a quarter and a third of return for the S&P 500. And while yes, it is cap weighted, some of those companies that, maybe didn't, perform quite as well, that was a greater number than those that performed really well. So what are we looking at there? What does that, potentially speak to? I think that there's certainly some concerns there. And I think it's just one of the things that we continue to talk about is just being mindful of having overexposure and potential downside of those, really crowded trades. So following the crowd, being biased towards what we're seeing on the news all the time. I think there's certainly an issue there. So diversification matters. And something about diversification is that you're not always going to catch the upside of everything, but it certainly can help you on the backside or the downside of things. Another area that's certainly an issue is political tensions. And we've seen from an economic standpoint and just, broadly is what's happening abroad, what's happening with our politics here in the United States, as far as our global impact. I certainly think that, what we're seeing in these other countries is that's speaking to a broader audience and certainly some bigger issues here. So there's definitely some tensions, and that's certainly something that we're going to continue to keep an eye on. Again, it might get to a point where we get more isolationist, and it's not just we as a global economy might start looking at that. So the things that the United States has done could have potentially outside effects to other countries and some downstream effects where we start to see them kind of, bolt up their economic borders, so to speak. And that could potentially have some volatility or impacts on volatility and market confidence. Another area that we're looking at is another challenge is some of the private debt headlines that we've seen is, there was a couple of major bankruptcies in 2025 that were in the private debt space. And that area seems to be in rapid growth. They tend to have a little bit looser underwriting standards. And there's been an increase in investor access. So not just the ultra rich or those family offices or the institutional investors have access. Now we're starting to see this drip down into the everyday investor like you and me. And so having that exposure, what does that look like? Is there an element that we need to be aware of as it relates to some of that private debt? And what are we, are you exposed to it? Are you not? What does that ultimately look like? And while I don't think it's an immediate threat necessarily, it's certainly something that is worth monitoring because it could potentially have downstream effects, potentially liquidity issues, defaults. And so, that's certainly something that we're keeping an eye on. So those are some of the challenges, the concerns that we have going into 2026. And it is something that I think going forward, I'm always cautiously optimistic. I think it's just the only way that we can be as investors is to look at the blue sky that's available for us to fly to and truly try to attack it. But with the idea that, hey, there might be some strong headwinds, there might be some clouds ahead, but we need to be flying in the right direction to ensure that we're going to stay on track. And my role is not to call every market move. I really don't go there. I think it's helpful to look at what the experts are saying, what analysts are looking at, what people that are a whole heck of a lot smarter than me. That's a great way for me to kind of set it up. And then it's my job to help you prepare for change and stay aligned with your long-term plan. And if you don't have a long-term plan, this is a great time to get that in place. And when I look at, thinking about, what the future holds, what forecasts look like, I think in practice, what it means is, number one, keeping your portfolio aligned with your goals and align that with your risk tolerance. Now, I think that's a little bit of an overused word or phrase for risk tolerance, but if you are concerned about what's going on, if you are unsettled by volatility, then your portfolio, your economic, your financial situation needs to reflect that as well, because there might be some dissonance if you're overly risked and you're not prepared for it. Another thing is to adjust thoughtfully as opportunities or headwinds emerge. This isn't about tactically buying and selling and getting in and getting out of the market. It's about adjusting to what you believe is your personal financial situation, and then aligning that with your investment strategies, and then making small adjustments along the way. This is something that we talk with all of our clients about, is making wholesale changes all the time is actually incredibly disruptive to overall financial success. It's about staying focused. It's about directionally moving in the right place, but understanding at what speed should we be moving? What should strategies, what are the tactics that we should be implementing to be moving in that direction, and then change those over time. Not vastly different than you might see in a game plan for a football team or a hockey team or some sports team, that, hey, they this is what they want to do. This is how they want to do it. But throughout the game, things change. The other team might throw something different at them. So they need to be able to move and change things slightly and just make those adjustments. So the same thing goes with investments and your financial plan. The last thing is managing cash flows, taxes, and risk proactively, not reactively. This is something about having those conversations ahead of time, not freaking out and panicking and then having the conversation. It's about making sure that you understand kind of what the landscape looks like for you and not being surprised by it. Hey, gosh, there might be some surprises, but if you actually know how to navigate it, or you've talked through some of these issues, then making those changes or making those steps, those corrective steps, and making those course corrections along the way, I think is incredibly important. But in any environment, the most effective tools that we have as investors, as you're growing your wealth, is going to be patience, discipline, and a clear plan. And I think for us here at 4 Points Wealth, it's really important to make sure that people understand that they understand what that looks like. And we work with our clients hand in hand to help them with the patience, to help them with the discipline, and to put a plan in place that makes a lot of sense for them. It's a pragmatic approach to something that can seem emotional and, frankly, can be a little bit challenging. So no one knows exactly what is going to happen and what will unfold in 2026. But what we do know is that clients who stick to thoughtful plans, who have intentional strategies, tend to come out ahead, flat out. There is a lot of studies out there that show that if you work with a financial advisor, you tend to have better financial outcomes, flat out. And if you're thinking about how your plan is positioned or whether it's time to update your plan, that's where we come into play. We're here to have that conversation, and we love having those conversations. So let's make sure that in 2026, you're not just reacting to the markets or reacting to your financial situation, but you're moving forward with clarity and confidence.